Will the pause on interest rates drive up Canadian housing prices? Before I answer the question, let me share this clip from Global News with you.
There are signs we could see housing activity pick up steam this spring, even though the number of homes selling remains significantly lower than last year.
The market did slow in December, January, and has picked up in February. We've seen volumes increasing from coast to coast.
The CEO of Royal LePage is optimistic about the spring market.
People will feel comfortable that interest rates aren't going to depress home prices in the future. In other words, we've reached the bottom of the cycle and it's uphill from here.
But not everyone sees it that way. A new report from RBC economist Robert Hogue suggests activity will hit bottom sometime this spring, and prices will level out a few months later if the Bank of Canada is done raising interest rates. The forecast, a 15% decline in national home prices, with roughly half of that still to come. Some of the biggest price corrections are expected in Ontario this year. Bancroft, Northumberland Hills, and Woodstock Ingersoll top the list, with expected declines ranging from 40 to 50%. That's according to new research from Desjardins. It expects a 20% correction for the Greater Toronto Area, which is not what Toronto realtor Pritesh Parekh sees in the cards.
I'm expecting a boom, if I had to guess right now, based on the fact that February has been picking up week after week, plus the supply has been relatively low.
Low supply in Toronto has already spurred the return of competition among buyers.
Bidding wars, I'm definitely starting to see more of those come back right now. The ultimate question is this going to be a blip for seasonality, and then do we go back to a little bit of slowness again?
The wild card is what the Bank of Canada will do when it comes to interest rates. The central bank announced a conditional pause Wednesday, and it reserves the right to start hiking again if needed. Anne Gaviola, Global News, Toronto.
As with everything else, people have opposite opinions. On one end, they believe that we have hit the bottom and things will just go up from this point on. On the other end, they think that the worst has yet to come. Prices may fall another 10% or so before they level out in a few months. Which side are you on? Here's how I see this. They seem to be on opposite ends, but they are really just saying the same thing. What do I mean by that? The optimistic side thinks that we have hit the bottom already. The pessimistic side thinks that it will take a few more months before we hit the bottom. You see, what they are both saying is that we should see the bottom in 2023. So the general consensus is that the market will be on the road to recovery. Does a few months' time make a difference in the long run? No, not at all. Here's the thing. It is impossible to time and catch the rock bottom. When the market was at the peak, people were waiting for the market to crash. When the market crashed, they are waiting for the market to go even lower. Then they missed the bottom and they got frustrated. So they wanted to wait for another crash and the cycle continued. My winning recipe is to stick to the same old principle. Real estate prices fluctuate up and down over the short term, but the long-term trend is always up. If you buy and hold, you always win. So every year I put aside some money to invest in real estate, including last year during the market crash and back in 2009 during the Great Recession as well. If you are ready to invest now and enjoy the long-term gains, you can schedule a call with me at the link below. Subscribe and hit the bell to stay on top of the market.